Registrations are now open for our ACCA Performance Management exam course. Get access to our comprehensive playlist of over 46 hours of content, including concept videos covering the entire syllabus, exam videos explaining how those concepts are tested in the exam, and question videos to help you with exam practice. Subscribe to one of our packages. The smallest package, for $10, you get access to the entire course for 7 days, or you can subscribe to one of our longer term packages. For more information, check out the links in the description below. And now, on to the video. Hello everyone, and how are you all doing today? So today we're going to be doing yet another practice question from the ACCA Performance Management exam. And the question we're going to do is from the December 2015 exam, Section B, question number 5. So this is an older exam format prior to September 2016. So back then Section B was the written questions rather than Section C like it is now. And as you'll see, this question is not for the 20 marks that we expect in the current format, it's for 15 marks instead. But that being said, it's a very good question from a conceptual point of view, which is why I've chosen to do it, because it covers a topic which is quite commonly tested these days in the exam and in recent sittings, which is divisional performance measures such as return on investment and residual income, etc. Right? And these questions usually have a calculation part and an analysis part, as most Section C questions do. So one thing that I've done to be slightly different this time around is that instead of doing the question in a spreadsheet, I'm going to be doing the question in a Word file. Now, why is that? Because I realized that most of the calculation-based questions, I was doing them in spreadsheets, which is fine because you'll usually get a spreadsheet in the exam for those calculation-heavy questions. But sometimes students have said that they've gotten a word processing file instead, where they had to do a question which included some calculations. So just that I can show that how you could address calculations within a Word file, I decided to do this particular question in a Word file. Okay, so we'll be using our handy dandy calculator here to help us along the way. Okay, so without further ado, let's get into the question. Let's start by labeling the question, which is question number 5 in this case. Again, make the question labels distinct so that they're easy to see by the marker. Okay, so let's get into the question, and as always we'll start by reading the requirement first. Okay, so the first part A, for 5 marks. For each division for the year ended 31st August 2015, calculate the appropriate closing return on investment. Let's stop here. Return on investment, remember, it's a ratio, and you have your profit over your investment or capital employed. So they've clearly told us that we need to use the closing balance of the capital employed. Okay, sometimes it can be average return on investment, where we need to use the average balance by taking the average of the opening and closing balance, but here we need to use the closing balance. Okay, so let's make a note of that mentally. Okay, on which payment of management bonuses will be based? Briefly justify the figures used in your calculations. Okay, what do they mean by justifying our figures? Well, remember that these calculations for divisional performance, such as ROI and residual income, they're based on controllable profit and controllable capital employed. And when it comes to controllability, certain types of income and expenses are controllable, certain types are not. And same with assets and liabilities. So we only need to include those things which are controllable by the divisional manager in the calculation of the return on investment. So we'll exclude any uncontrollable expenses or assets, etc. from the calculation, and we need to justify that fact. And this is a standard type of question for ROI, that not only do we need to do the calculation, we need to justify the numbers we use therein. And they've given us a note. They've said 3 marks are for calculations, 2 marks are for the discussion or the justification. So please make sure that you do include that justification, because students are oftentimes so focused on the calculation they don't include the justification, and on that basis you automatically lose 2 marks from the get-go. Okay, so let's go through the question then. So technically the numbers are down below here, and this is all basic fluff, okay? But let's just quickly read through it just so that we have an overall idea about how things are. So it says Cardell Industrial Metal Co. is a large supplier of industrial metals. It has two divisions, Division F and N. Each division operates as an investment center, and as we know, just for recap purposes, investment centers, we do their performance evaluation usually based on the ROI, okay? With each one having, okay, so now we have some important information. Full control over its non-current assets, okay? So for our capital employed calculation, non-current assets are fully controllable, okay? In addition, both divisions are responsible for their own current assets. So there's control over the current and non-current assets, in controlling their levels of inventory, cash, etc., all of those things, and receivables, okay? Similarly, each division has responsibility over its current liabilities and deals with its own suppliers. So everything, the liability, current liabilities, the non-current assets, and the current assets are under their control. So it was important to go through this paragraph, right? So that's why I generally recommend that, even though in a lot of cases you wouldn't need to go through the paragraph, just to be safe, it's good to read through the start of the question, just in case it has some important information, okay? Like I said, better to be safe than sorry. Okay, let's move on to the next paragraph. Each divisional manager is paid a salary of $120,000 per annum plus a bonus based on the ROI. Okay, each divisional manager is expected to achieve a minimum ROI of 10%. If the manager only meets 10%, they are not awarded the bonus, but for every whole percentage point above 10%, they get a bonus equivalent to 2% on the annual salary, subject to a maximum bonus of 30%. Okay, so this was not really that relevant for our calculation here, but that's okay. We have an idea about it, so it'll help us in the upcoming parts. Okay, and then we have our numbers. So they've told us already that the non-current assets, current assets, and current liabilities, which are the trade payables in this case, are all controllable. So controllable capital employed will include all of these in the calculation. But what about the profit? Okay, so we need to do this for each division. Let's start. So let's start with the justification, right? As we can see, both divisions fully control their non-current assets, current assets, and current liabilities. This means that they should all be accounted for in the capital employed used to calculate the return on investment. ROI for short in brackets so that we can use that shorthand later on, okay? Then the second part of the ROI formula is controllable profit over controllable capital employed. Let's talk about the profit, okay? Let's just read the last paragraph before we do that. During the year ending 31st August 2015, Division N invested $6.8 million in new equipment, which is expected to increase productivity by 8%. Division F has made no investment, even though their equipment badly needs updating, and the manager said he has already had to delay payments to suppliers because of limited cash. The computer system will have to wait, although the cash balance is still better than that of Division N. So all of this information will be relevant to the analysis that is typical for ROI questions, where we need to talk about how they manipulated the ROI metric, okay? But not relevant to our current calculation. So in our current calculation, we have the sales, controllable profit, less fixed head office costs, and net profit. So things are easy. They've already given us a controllable profit, which is rare in the exam. So usually they don't give us a controllable profit, they give us a profit and they give us a head office cost, and because head office costs are not controllable, we add them back to the profit. We wouldn't need to do that in this case, so we'll just mention that. The controllable profit without the head office costs is already given, so we do not need to calculate it separately, right? And generally speaking in the exam, the most commonly uncontrollable cost is the head office cost that you need to deal with. It's very rare that they give you other uncontrollable costs as well, though it is possible that that's tested as well. Okay, so we've talked about our discussion already. We've justified the numbers, and now we're going to do the calculation. So we have the two divisions, division F. So for division F, the ROI is equal to, we'll write down the formula just to be clear, controllable profit, let's put it in brackets because there's a space between the words, over controllable investment, or controllable capital employed, let's put it that way. Okay, which is equal to, for division F, the controllable profit is 2645 in thousands, but let's just make it 2645 because everything's in thousands, so it'll cancel out, divided by, and what was capital employed? Total assets less current liabilities. So total assets would be your non-current assets 9760 plus current assets 2480 minus 2960, the current liabilities. Okay, so what do we end up with? Let's use our calculator. 2645 divided by, in brackets, 9760 plus 2480 less 2960. Okay, so we end up with approximately 28.5%. Okay, and be sure to double check the numbers you key in into your calculator. Always take a scientific calculator to the exam, right? So that the numbers are clearly displayed. Don't take one of those calculators where each of the numbers has to be keyed in separately. You can't use the brackets or anything, right? That's just a mess. Okay, so yeah, the numbers are fine. So that's division F. And the good thing is, because we have this format, we can simply copy and paste this in the computer-based exam to amend it slightly for division N. So now what will our profit be? Controllable profit is 1970. Okay, so 1970, and non-current assets is 14980. So 14980, 3260. So this is 3260 minus 1400. Okay, so what does that give us? Let's just amend our calculation. 1970 divided by 14980 plus 3260 minus 1400. We end up with 11.69%, approximately 11.7%, right? So 11.7%. Now they haven't mentioned any decimal places that we need to round to, so we'll keep it like this. But if they said 2 decimal places, then you should have put in 11.70% and so on, right? Okay, and you need to be careful about that because they could deduct marks otherwise. So that's the first part, 3 marks for calculations, 2 marks for explanations, and we've done both. So 5 marks down, 10 marks to go. What's the next part? Based on your calculations in part A, calculate each manager's bonus for the year ended 31st August 2015. Now, a question students often ask is, what if our calculations in part A are incorrect and we do the analysis in part B? Would we not get any marks? No. So if based on your incorrect calculations in part A, you do the correct calculation or analysis in part B, you'll still get marks for part B. Obviously, you won't get marks for part A, but you'll get marks for part B, okay? So head into these questions without any fear. Furthermore, if you're not even able to do a calculation for part A, go by something that you can assume, make a rough assumption, right? Or whatever basic calculation you're able to do, pick the numbers based on that and still do the analysis. Don't lose marks for both parts just because you were unable to do the first part, okay? So calculate each manager's bonus based on your calculations in part A. So let's start with division F as again. So division F, once again, use headings and everything to distinguish different parts of your answer. It makes things more presentable. The manager earned an ROI of 28.5%. Okay, so what was the basis of the bonus? That was in the second paragraph. So they say that each divisional manager is paid a salary of 120,000 plus annual bonus based on the return on investment, which is fine. Each manager is expected to achieve a minimum ROI of 10%. So he's done that, 28.5. If the manager only meets 10%, they are not awarded a bonus. So he's done better than that. However, for each, now we need to be careful. Notice this, whole percentage point, not an incomplete percentage point, whole percentage point, above 10%, which the division achieves for the year, a bonus equivalent to 2% of annual salary, which was 120,000, is paid, subject to a maximum bonus of 30% of annual salary. So let's do the calculation. So whole percentage point, this is 18 whole percentage points above 10%, right? Because the 0.5% is not a whole percentage point. This translates to, so for each he gets 2% of the annual salary. 18 into 2, which is equal to 36% of bonus of the annual salary. However, the bonus is subject to a maximum level of 30%. However, since the bonus is limited to a maximum of 30% of the annual salary, he will get only 30%. This will be an amount of, and then we just multiply the 120,000 into X for multiplying, right? Or you could use the asterisk, up to you, 30%, which is equal to 36,000 in my head, but just for making sure. So that's another point, right? Even if you're confident about your mental math skills, I would still recommend use the calculator just to double check, right? Not in ridiculous things like 2 plus 2 is equal to 4. You can be confident about that, but in things like this, even if it's quite obvious what the answer is mentally, still better to be safe than sorry, right? Okay, so 36,000, unless you're really short on time, okay? And we can now copy paste the same format to use for division ends manager. Okay, so the manager earned an ROI of 11.7%, if I remember. Yeah, 11.7%. So this guy didn't earn much of a ROI, 11.7%. And usually it's the one who earns a low ROI, which is doing all the good stuff in the analysis, and the one with the high ROI is doing the bad stuff, but we'll get to that later. This is only one whole percentage point above 10%, because the 0.7 is not a whole percentage point, which now translates to 1 into 2, only 2% bonus of annual salary. This 9 is not relevant here. This will be an amount of 120,000 into 2%, which is, I believe, 2,400, but once again, let's check just to be safe. Into 0.02, we get 2,400, okay? So, and they've just asked to calculate each manager's bonus, not to analyze or anything, just for 3 marks, so we're done, okay? So that takes us on to part C. Okay, final part for 7 marks. Now notice 8 marks for the calculations, 7 marks for analysis. So approximately half and half. And that's something I keep reiterating to students. Analysis is critical in this exam. It's easy to do not be intimidated by it, and it's worth nearly the same amount of marks as the calculations. Sometimes you'll get the entire section C, right? All 40 marks for just analysis, no marks for calculations. That can happen too. So you need to get comfortable with analysis, not just for this paper, but for your professional level papers, which are mostly going to be analysis based. It's easy, guys. It's nothing to be scared of. Just need some practice and confidence. That's all. Okay. So part C, discuss whether ROI is providing a fair basis for calculating the manager's bonuses and the problems arising from its use at Simcoe for the year ended 31st August 2015. So 2 parts. Discuss whether it's providing a fair basis, that's one part, and the problems arising from its use, okay? And this is a typical ROI question, that there'll be some manipulation going on for the ROI. The guy with the higher bonus is manipulating it, and the guy with the lower bonus is doing everything right, and we need to analyze that, okay? So let's talk about first the fair basis. The ROI can potentially provide a fair basis for calculating the bonuses. However, we need to keep in mind that it can be manipulated as well. Why? Because as we've covered many times before, because it is calculated based on accounting numbers, and as finance professionals we know accounting numbers can always be manipulated, okay? So what's the manipulation going on? That was there in the last paragraph. So first manipulation, during the year ended 31st August 2015, Division N, so this is the manager with a low bonus, invested 6.8 million in new equipment, okay, which is expected to increase productivity by 8%. So he did a good thing, but what happened? If he bought 6.8 million worth of new equipment, this went up by 6.8 million, right? And if your non-current assets go up, what happens to your ROI? Remember, non-current assets are in your denominator. If the denominator goes up, the overall thing goes down. So his ROI would have decreased because of this. Whereas Division F made no investment during the year, even though the computer was badly in need of updating. So the Division F manager did not do so, even though he needed to, and his ROI, that means, is artificially overstated because this is understated, the denominator is understated, therefore the overall ROI is overstated, and he got this big bonus, whereas the guy who did the right thing got a small bonus. So let's write that down. Division F's manager bought new equipment which increased productivity and was in line with the business's best interests, right? However, this would have increased his non-current assets, which would have decreased his ROI and his bonus. On the other hand, Division N's manager did not invest in new equipment even though it was needed badly, right? This understated his non-current assets, which overstated his ROI and increased his bonus. Okay, so what happened here is that through manipulating the ROI by not buying necessary equipment, the manager for I mixed up the two divisions. So this should have been Division N's manager bought the new equipment and Division F's manager did not. So we need to be careful for things like this. Okay, so manipulating by the manager for Division F was able to get a higher bonus despite not working in the best interests of the company. This is not fair for Division N's manager, as he made the right decision but also received a smaller bonus as a result. Okay, we'll highlight the problems of this towards the end. Okay, then, and this is a typical type of part. One is that they'll manipulate the non-current assets by keeping old assets or not buying new ones. Okay, they'll also sometimes manipulate the current assets, but I don't think they have in this case. Instead, they're saying Division F's manager has said that he has already had to delay payments to suppliers, that is accounts payables, because of limited cash, and the computer system will just have to wait, even though his cash balance at Division F is better than that of Division N. Now, if you delay payments to suppliers, what are you doing? You're not paying them on time. What will happen to your accounts payable balance? It'll increase, right? Because you'll still not have paid that amount. So this amount will become overstated. Now, remember in that video where I showed you guys the ratio? What happens if the payables go up? The overall capital employed, where you're subtracting payables from the assets, will go down. And if the capital employed goes down, the denominator for the ROI measure goes down as well. That means the overall ROI will go up. So once again, he's artificially overstating his ROI through manipulation. So let's write that down. Furthermore, the manager for Division F is not paying suppliers on time. This is resulting in an increase in his payables balance, right? This will decrease the overall capital employed, which in turn will increase the ROI and the manager's bonus. Okay, once again, the Division F's manager is manipulating the numbers to increase his ROI and therefore his bonus. This is despite him taking decisions that go against the interests of the business, right? Okay, and now we can conclude with the risks, because we've talked a lot about ROI being fair. Let's talk about this. Based on what is going on, the ROI is not a fair basis for calculating the manager's bonuses, right? The manager for Division N is getting a lower bonus despite making good decisions, whereas the manager for Division F is getting a higher bonus despite making bad decisions. Okay, and let's highlight the risks. The risks of this are that Division N's manager might get discouraged and stop making the right decisions. So let's just list down these risks. Okay, that Division F's manager might feel that he can get away with making poor decisions and still get a high bonus, making him continue the same, right? That's a risk. Okay, that the old equipment for Division F decreases productivity overall, right? That the suppliers for division F, stop doing business with the company due to the delayed payments, right? There's all these different risks that can happen, okay? So I think that's more than enough. We've covered all the necessary parts. It's for 7 marks. We don't need to go overboard with the analysis. So I think we'll stop here, okay? But yeah, that's a typical ROI question. So let's just sum up basically what we've covered. We did the calculation, controllable profit over controllable capital employed, by justifying what should be included in the calculation, basically those things that are under the manager's controls. We did the bonus calculation where the trick was that it's based on whole percentage points, so we had to ignore the decimal points, and we had to consider the maximum limit of 30% of salary. And then we did the analysis, which is very commonly tested in section C of the exam. In this case, the manipulation was that Division F's manager was keeping the old assets, so understating his non-current assets, and he was delaying payments, so overstating his current liabilities, which was both in turn overstating his ROI and giving him a higher bonus. And that's the typical way they go about doing these manipulations, okay? So please be familiar with this type of question. It's a popular one. As you've seen, it's not really that complicated, so it should be easy marks if you get it in the exam, okay? So I hope you guys benefited from this video, and I'll see you guys next time.